New data shows U.S. home prices are dropping at a historic level.
According to Redfin, the median home sale price in April was down roughly 4% from last year. That's a decline of nearly $18,000.
Housing market bubble about to burst. Expert predicts 50% drop in home prices. Economic downturn. Homeowners brace themselves for a roller coaster ride. Millennials rejoice as housing becomes affordable again. A dream come true. The housing market crisis in America is worsening, with property prices experiencing the biggest drop in 11 years due to the decline that started in the summer of 2022. Although lending firms are already laying off employees and real estate analysts are sounding the alarm about a housing slump, the National Association of Realtors believes that home prices still have a long way to go before they reach realistic levels in overvalued markets. It's been forecasted that before 2024, property values could potentially decrease by 50%, leading to a significant decrease in home equity in a year. As a result, we must be vigilant and watch for any significant warning signs that may indicate we're heading towards another financial crisis. Today, we'll discuss a prominent investor's claim that the current resembles those that caused the 2008 financial crisis. Currently, the National Association of Realtors published a report highlighting the current poor state of the housing market in the United States. The report cited a decline of 21.7% in transactions during April and May, and further revealed that June marked the third consecutive month with a decrease of over 20% in house sales on a seasonally adjusted annualized basis. There has been a decrease in sales for all types of homes, such as single-family homes, townhomes, condominiums, and co-ops. Sales lowered by 23 and 20.04% respectively. Double-digit price declines have occurred in 37 of the nation's 50 largest cities in several areas. According to Lawrence Young, the chief economist at NAR, house prices may decrease up to 25% from their 2022 peak. The expert also predicts that there will be no increase in house prices in inflated markets in 2023, particularly in metro areas in the West. According to Young, the country's most expensive areas, including popular economic boom places such as Phoenix, Seattle, San Jose, and San Francisco, will see the biggest decline in housing prices. Recent data from Black Knight indicates that these metropolitan areas have already experienced a decrease in home prices ranging from 15 to 25%. San Francisco has been hit the hardest, with home prices down by 25% since their peak in May 2023. San Jose, Seattle, and Phoenix are not far behind. Markets in Tampa, San Diego, Austin, Texas, and Denver are also considered at risk. It has been reported that Valer Mortgage, a prominent mortgage company in Florida, now offers genuine price transparency. Despite this positive development, major banks such as Goldman Sachs have predicted that losses could double due to current economic challenges. Analysts from the bank have identified hot housing markets in the Pacific Coast and Southwest regions, including the San Jose and Texas MSAs. Even though affordability remains a concern for many economists, there is expected to be a decline of over 25% in the Phoenix and San Diego MSAs, which could pose a localized risk of increased delinquencies for mortgages originated in late 2021 or 2022. Affordability remains a significant concern for many economists. Black Knight reports that the national payment-to-income ratio presently stands at 34.8%, exceeding the 26.9% peak in 2006 before the Great Recession. This means that the monthly payment for an average price property of 30-year mortgage is now $600 or 40 years longer than a year ago, even with a 20% down payment. As a result, most experts in the housing industry anticipate a decline in buyer demand and a drop in prices later this year, particularly due to rising borrowing rates. The imminent rate hikes and limited supply have deterred several potential buyers. Potential home buyers are putting off purchasing houses until mortgage rates reach their highest point. This is causing a decrease in property demand and a drop in prices. The lack of available homes is mostly due to many homeowners feeling trapped in their current homes because of the low mortgage rates that have locked them in. These are just a few factors that make the housing market challenging for buyers and sellers. Due to the housing slowdown, experts at Vanguard are predicting a US recession in 2023. However, other property analysts also believe home values will continue declining this year. A well-known investor who famously profited from the housing market crash in 2007 is warning of another financial crisis. Dave Burt, CEO of risk management firm Delta Terra Capital, was instrumental in helping two investors featured in Michael Lewis's The Big Short make profitable bets on the mortgage market before the global financial crisis in 2008. Burt now believes there are currently unacknowledged risks that could lead to a repeat of the 2008 crisis. He is closely monitoring the financial system for any significant systematic issues. According to Burt, there are several reasons for this. He explained to CNBC that he has witnessed the severe impacts of economic downturns on societies and vulnerable populations. He specifically reflected on the period from 2008 to 2012 in the United States, marked by significant suffering for many individuals. According to Burt, there are several reasons for this. He explained to CNBC that he has witnessed the severe impacts of economic downturns on societies and vulnerable populations. He specifically reflected on the period from 2008 to 2012 in the United States, marked by significant suffering for many individuals. According to Burt, there are several reasons for this. He explained to CNBC that he has witnessed the severe impacts of economic downturns on societies and vulnerable populations. He specifically reflected on the period from 2008 to 2012 in the United States, marked by significant suffering for many individuals. Jeffrey Roach, the chief economist for LPL Financial in Charlotte, North Carolina, believes the current Fed outlook is reminiscent of 2007 before the housing market crash. Back then, the Fed was confident that the housing market was stabilizing, the economy was growing, and there were still no inflation threats, which led to their retention of a tightening stance on rates. However, as history has shown, those hopes were unfounded. As a result, investors should expect some volatility in the next few months as the economic outlook remains uncertain. Some investors were already bracing themselves for the worst due to the sharp increase in mortgage rates and ongoing decline in house sales. Last month, Elon Musk, the billionaire behind Tesla and Twitter, predicted commercial real estate is rapidly declining and home values will soon follow. During a housing market downturn, people's reactions can differ depending on the economy, employment, interest rates, government policies, and consumer sentiment. Homeowners and investors with a significant financial stake in the market may feel anxious or panicked when property values decrease substantially. However, it's essential to remember that real estate markets are complex and are influenced by various factors. According to NRA officials, there may be a significant drop in median home prices shortly. Moody Analytics predicts a further decline of 15 to 17% compared to the losses seen since July 2022. Economist Matthew Walsh, as reported by Yahoo Finance, shares this outlook while Morgan Stanley has not yet weighed in. The US Bureau of Labor Statistics reports that the unemployment rate has risen to approximately 4% this month. Many prominent businesses, stores, and other organizations plan to lay off many workers in 2023. Before the Great Recession, the highest unemployment rate was 4.4% in October 2006. Numerous households in America are under a great burden of debt, and a sudden decline in income could lead to millions of individuals failing to keep up with their mortgage payments. Moreover, the rise in layoffs across various businesses could further exacerbate this issue. Instead of worrying, let's focus on the opportunities a market correction can bring. It could allow many people to enter the market at a lower cost, including first-time buyers and those looking to upgrade. As the saying goes, adversity is the mother of progress. Additionally, well-planned investments have the potential to bounce back even stronger. So when facing the possibility of a 50% reduction in home values, remember to stay informed, make informed decisions, and prioritize your long-term goals.